According to YouTube's analytics page, 56% of people watching this show are not currently subscribed to this channel. I think we should change that. Of those people, only 20% of them have clicked the bell icon for notifications every time that we upload a video, Mondays, Thursdays, and soon the third show a week that we're going to be doing with the FTSE AIM. More on that in a moment. You'll get notified that that's been uploaded and there's a new video to watch. Listen, if you're enjoying the show, please do me a massive favour and subscribe to the show, because the more subscribers we have, the more reach the show gets, the more other people get to see it, and it kind of just grows and builds from there, kind of exponentially as well. So it's pretty exciting. So listen, if you're enjoying the show, I know you love clicking the thumbs icon on these videos, and I'm often asking you guys to do that. But hey, if you haven't subscribed to the show yet, please do. It'd be great to get that 56% up higher and get that 20% bell icon clickers higher as well. So, and I'll report on that in a week's time. In today's episode, we've got a big company to take a look at. We're looking at Astrazeneca PLC. Hey there guys, welcome to the FTSE Show with me, Chris Chillingworth, the show where we dissect UK FTSE stocks, rip them apart, look at all the financials, look at the charts, look at the prices that we can get the shares at today, and we're looking for companies that are ticking a certain criteria, a certain box. We're looking for companies that are going to have the greatest odds of growing 300, 400% in share price value over the next 10 or 20 years. And we're trying to identify those companies and share them on the show, as well as looking at some of those very poor companies that we have seen as well throughout the series. Listen, fantastic support from everybody. We are now regularly getting more than 1,000 views per video. The Smith and Nephew one didn't do very well on Thursday. I'm not entirely sure why. It's kind of a bit odd. But all the other shows, we've been getting over 1,000 views on them. It's awesome. Thank you so much for your support. Thank you for commenting on the videos as well and engaging in some dialogue with me. And listen, I am not proclaiming to know every single little thing about these companies. So if you're watching these shows and you know more about these companies than what I'm expressing in the videos, please feel free to share them in the comments. You know, more information is always better. Make sure it's factual. I'm not interested in people's opinions, but if it's fact, then share it, because it's awesome. You know, we want to know that stuff. So we're going to take a look at Astrazeneca today, pharmaceutical and biotech company. Without any further delay, let's dive into those numbers. Okay, then let's take a look at Astrazeneca, EBIT code AZN in the FTSE 100 index, and these guys are in the pharmaceuticals and biotech sector, of course. Big company this, and the results are somewhat surprising and not necessarily consistent with share price. We'll take a look at that in a moment. But as you can see here, from 2008, it's as far back as the data goes for what we've looked at. And you can see between 2008 and 2011, things looking pretty solid. 31.6 billion turnover in 2008, went up to 32.8, 33.2, then up to 33.5. So, you know, every year growing, moving upwards. And then we started to see a period of decline. We were looking at 2012, looking at 27.9 billion in revenue. So revenue drops down by about 4 billion. And then it drops to 25.8. Then it kind of goes up to 26, but then drops the following year in 2015 to 24.7, down to 23, down to 22. And in 2019, we've managed to go back up to 24 billion, but we're still quite a long way from the 2011 peak of 33.5 billion. So I'm not sure why AstraZeneca's revenue fell from 2012 onwards, but we've definitely seen a sustained period of decline, apart from 2014 where we jumped up 1 billion. We've obviously then continued that decline, falling 2 billion the following year. And so really we've had this sustained period of decline, apart from that anomaly, from 2012 all the way down to 2018. And then in 2019 is the first sign of reversal, I suppose. It's been the best year they've had in the last 4 years. And it's encouraging, but obviously the decline is somewhat concerning, because 2019 could be another 2014, you know, a little spike, and then we continue going down next year. So it's interesting to try and work out what's going on here, what's going on at AstraZeneca that's caused what is essentially 11 billion of decline in revenue between 2011 and 2018. That's quite substantial. That's a third of their revenue just gone in that period of time. So interesting to know what that's all about. What we will notice as well is that since that period as well, the cost of sales went down with it. We have historically at Astrazeneca here been running at about an average of 80% gross margin every single year back to 2008. So some years, it's 79%, sometimes it's 78%, other years it's up as high as 82%. But consistently, on average, over the last 12 or 13 or so years, we're looking at an 80% average gross margin rate, which is fine. That's pretty good. This means that the company are keeping 80% of the slice of the cake. We don't see that very often in many of the companies we look at on this show. So they're doing pretty well in terms of the gross margin. That doesn't necessarily mean they're doing well, and we'll come to that in a moment. Looking at expenses have been going up over time. Now, we would expect expenses to go up over time because the cost of hiring staff has obviously gone up over the last 12 years, and so costs to do pretty much anything have gone up in terms of inflation and things like that. So what we look at is well, has the revenue grown faster than the expenses, or have the expenses grown faster than the revenues growth? Now, obviously, we haven't seen any revenue growth. We've seen a revenue decline, and so obviously the gross margin has been falling. The gross margin back in 2008 was 25 billion. It's now down to 17 million in 2018, popped back up to 19 million last year in 2019. We're still down 6 billion over those years though. And so there's again been a steady decline in the gross profit. So when we look at the expenses provide us on this spreadsheet here a percentage of the gross profit. How much of the gross profit is being spent on expenses of running the business? And as you can see, back in 2009, for example, we're looking at 43%. The next year, 2010, only 40%. So only 40% of the gross profit being spent on expenses. But as you can see here, if you're watching this on YouTube, 60% in 2013. So we jumped from 40 to 60 in just a couple of years, then up to 65% or just shy of 65% in 2014. And we're now sitting about 62%. So we saw a bit of a decline over 2015 to 2017 in terms of the costs of running the business. They fell, which was good, but we started to creep back up again. And in fact, in the last 4 years, we've gone from 51 to 58 to 60 to now 62% of the gross margin being eaten up by expenses. So we've obviously lost a bigger slice of the cake there to expenses. Now, if we actually take a proper look at this and we look at the raw figures, you can see here that really the expenses haven't really changed. We're sitting at about 12 billion a year, roughly, on average. What's actually changed, of course, is that the gross profit has been falling. And so obviously 12 billion of a falling gross profit is going to increase that percentage, right? So actually expenses haven't been going up as such. It's just that the gross profit has been falling and the expenses have been staying in the same place. Therefore, expenses now make a bigger percentage of the gross profit. So that is a concern, obviously, in itself. Not so much that the expenses are going up, but the gross profit's going down and the costs of running the business are still remaining the same. And that is just something that I would be very mindful of if I was investing in this company. I'll be wanting to keep a very close eye on seeing where this goes, because obviously we've gone from 50% in 2016 to now 62% of the gross profit being eaten up by expenses in 2019. And if that continues in this fashion, then obviously we're going to have some concerns and some issues, because it's going to eat away at the profits, of course. R&D is very high, as we would expect from a pharmaceutical and biotech company. They have to spend on R&D just to compete. This is a prime reason why I'm not a big investor in pharmaceutical companies. I'm not keen on a company that's got to pay, like AstraZeneca here, 30% of their gross profit on R&D just to compete. They lose 30% of their profit on R&D just to be able to compete with their competitors. And I prefer a company that doesn't have to spend its profits on R&D to compete. I'd rather the profits end up with the shareholders, right? But as we can see, historically speaking, from 2008 to 2011, we're looking at about 20% in the gross profit being spent on R&D. That cost then went up to 23% for 2012 and 2013. Then we got up to 27%, up to 30% in 2015, 31%, 32%, 34%, back down to 32% in 2019. But this is quite high. This is far higher than I would be interested in any company. paying 30% or more in R&D costs generally puts me off. It wouldn't be a deal breaker if everything else was ticking all the boxes and everything was looking great. I could probably be persuaded to become an investor in a company like this, but we've got declining revenue, we've got declining gross profit, we've got expenses staying the same, we've now got increasing R&D costs as well. So as you can see, in 2019 they spent $6 billion on R&D, which is the most they've ever spent in the last 12 years worth of data here. Interest on debt. This is an interesting one because we're now looking at the operating profit down here. Well, as you can see, back in 2009, for instance, we're looking at 10 billion, nearly 11 billion in 2009. By 2013, down to 3.2 billion. So from nearly 11 billion down to 3.2 billion in just a few years. So operating profit has dropped off dramatically. And then we come down to 2018, for instance, 860 million. We're not even reaching a billion anymore in operating profit. So we've gone from 11 billion in 2009 to 860 million in 2018. That's a significant drop in operating profit. And what worries me more than just the drop itself is the fact that it's a sustained, prolonged pattern of operating profit falling. It's not just been a one-off bad year. This has been falling and falling and falling year after year over a long period of time. And again, 2019 seems to be a bit of a spike up from 860 million back up to 1.3 billion, nearly 1.4 billion. But I mean, bear in mind in 2017 they'd fallen to 1.8 billion. We're still a long way away from recovering the droppage of 11 billion down to 860 million, now back up to 1.4 billion. Well, it's a step in the right direction, but we want to see more. I'd want to see a bit more reassurance in these numbers in the years to come, basically, before I'd be even contemplating looking at this in any finer detail. Having a look at the interest on debt then, the interest on debt has been rising. We were looking at about 5% in 2008. That's the kind of level of the debt that they were carrying. The interest on debt was at 463 million a year, and you could argue it stayed about 500 million a year between 2008 and 2012. And then in 2014, we've seen a significant jump. So they've obviously taken on a lot more debt from 2014 onwards, and this is a pivotal moment because this will correlate with some changes in the share price as well. But they've obviously inherited some debt because the interest on debt has jumped quite dramatically to 50%. So 50% of the operating profit being spent just on interest on debt alone. Again, that's a red flag for me. It's too high. And there have been years such as 2018 where 150% of the operating profit was being spent on interest on debt. What that means is obviously they are not making any profit that year because they've spent more than they have in terms of profit on interest on debt. The interest on debt coming in at 1.3 billion and then he had 860 million in profit. Last year that fell back down to 91%. So 91% of the operating profit was being spent on interest expense. That's way too high for me. That means that there's some serious issues in terms of the debt level that's being carried by this company. Now, that's fairly common with pharmaceutical and biotech companies. They tend to borrow a lot of money to do what they're going to do, but that's a concern for me. I'll tell you why it's a major concern for me, because of the profit level of this business, the profitable power of this business. As you can see, from 2008 to 2012, doing really well. 18% to highs of 23%. So between 18 and 23% over 2008 to 2012 on a yearly basis, net earnings. Really healthy, great numbers. We're very, very happy with that as an investor. Of a company that I was invested in of this size, we're making 23%, even 18%, I'd still be very happy. But then from 2013 onwards, the profits fell to 8%. We had a 3.4% year the next year, 5.4, 7.8. Still sticking, underneath that 8% mark. That's a little bit low for me, bit of a concern. Not liking the fact that they've dropped off from the likes of 22% down to the likes of 8%. It's a big drop off. And that is obviously largely attributed to the drop in revenue, but the expenses staying the same and the interest on debt going up. All of these things, the R&D costs going up, these are all concerns. These are all going to rip away from the profits. And then you can see the last 3 years, 4.9% in 2017. Then a loss year in 2018 and a loss year in 2019. Now, something to make very clear before we move on. Astrazeneca actually posted profits those years. In 2018, they posted a 2 billion profit. In 2019, they posted a 1.2 billion profit. Now, these are still bad years for Astrazeneca, but the reason why they posted profits, and we've got them down as negatives, is because of extraneous sales of goods, of services, of assets, whatever it might be. Basically, money came in for AstraZeneca in the last 2 years that had nothing to do with the recurring everyday business. And when I analyze these companies, I'm not interested in one-off sales. You know, if some company sells off a license or a right or a patent, or if it sells off the US arm of its business and makes a ton of money off the back of it, I'm not interested in that when it comes to my analysis. Yes, I recognize that the money comes in, I'm not just ignoring it, but it's nothing to do with the recurring everyday revenue of that business, the recurring money that's coming in and the costs of running that business. And so I omit that from the results because I just want to look at what is the actual underlying business actually achieving. And if we take the extraneous income and profits out of this, actually the underlying revenue, the underlying recurring everyday business of AstraZeneca lost money in the last 2 years. And that's obviously a big concern for me. In 2018, we've got a 364 million loss. In 2019, pretty much a 200 million loss. Now, obviously, they didn't post that. They posted profits. But my point is that the underlying recurring business, if they hadn't have had that extraneous income coming in, those are results that they would have posted based on the underlying revenue of that business. And that's a big concern for me. These are numbers that are going in the wrong direction. This is largely attributed to, from what we can tell from the income statement, this is due to the fall in revenue, the downward trend in revenue. This is due to the expenses pretty much sticking where they are at 12 billion a year. This is down to the R&D costs now rising up to over 6 billion a year. It's never been that high in the last 12 years, so their R&D costs are going up and up and up. And this is obviously the interest on debt, the 1.2 billion that's been spent on interest on debt alone, also rising. And so all of those added together, we've got some issues, and we've got issues to the point where the everyday recurring business of AstraZeneca is no longer making money. It's not a profitable experience anymore. Looking at the balance sheet is in okay shape. They've got 5.3 billion in cash, so they're a very cash heavy company. But notice, 2013 they had 9 billion. 2010 they had 11 billion. So 5.3 billion is actually quite low compared to where they've been historically in terms of cash. And when we look at the total current assets, we're looking in 2010, this company was a company sitting on 25 billion in terms of current assets, now only 15 billion. So the amount of assets the company holds has dropped dramatically over the last 10 years. However, when you look at the non-current assets, as the assets that can't be turned into cash particularly quickly, and you'll notice here mainly in intangible assets, so that's going to be rights, patents, trademarks, anything like that at all, which is obviously going to be very important to a pharmaceutical company, especially when it comes around to patents or patents. I don't know how you want to say it. I'm UK based, I have no idea. But we're looking at, you can see here, 12 billion in intangible assets, so assets that you can't touch or hold. It's just like licenses, like patents, like trademarks. In 2008, sitting on 12 billion worth of intangible assets. By 2016, that's gone up to 27.5 billion. But then again, last 4 years, 2016 onwards, 27.5 down to 26.1, down to 21.9, down to 20.8. This is a decline in value. The intangible assets are falling in value. So that's interesting. Why is that happening? Very interesting to me. Now, property, plant and equipment value is going up. So they're buying premises maybe, but the value of their intangible assets seem to be falling, which is very interesting. Looking at the short-term debt, 1.8 billion, that's not so bad. But looking, and it's messed up my formulas, because this company in the last 2 years have been making a loss on the recurring everyday business, right? And so it messes up my formula a little bit. But you can see here the current held long-term debt. This is debt that's due to be paid over a year or longer away. It's 15.7 billion. So that's a big liability that's been held by this business. It was only last year where they were sitting at 17.3 billion. That's the most they've ever held in 1 year. So we're very high at the moment at 15.7 billion. Right now, there's no way of calculating how long it's going to take them to pay that back, because the last 2 years have been making a loss. So that's a big concern for me. Unless they've got other sections of their business that they can sell off for big billion-pound profits, which I assume eventually this company are going to run out of. When they come back to relying on the recurring revenue, something's going to need to change. Otherwise, they're losing money right now, and they've got 15.7 billion worth of debt to be paid. Now, a company like Astrazeneca will probably find a way of doing that, but it's a concern for me as an investor. And so when we come down to the shareholder equity of this business, equity is essentially assets minus the liabilities equals what's left. What's the difference? That is essentially what we mean by equity. This is the concern for me. In 2012, they're sitting at 24 billion. This year, or 2019, the most recent report, down to 14.5 billion. They've lost 10 billion in equity over the last 8 years. And that's been consistent. There's not been a spike here and a spike there and a drop down here. Every year, we've basically just watched that fall every single year by a few billion, down to the point where in 2019 we're sitting at 14.5 billion in equity, 10 billion lower than where they were in 2012. So that's a concern, another concern for me. Obviously the assets outweigh the liabilities, but the liabilities are gaining on those assets. Their liabilities are rising faster than the assets are rising, and as a result of that, equity is dropping. So that's a concern, unfortunately, for me. Another concern to add to the list, I'm afraid there are a lot of concerns here. Retained earnings, 2010 sitting at 18.2 billion. Then since 2010, every single year we've watched it decline. We're just watching it fall, 20, 30% some years. It's fallen in value down to now 2.8 billion. So this is a company that were holding 18.2 billion in their retained earnings, now down to 2.8 billion. This is a trend that won't last much longer. They'll start to go into negative retained earnings, maybe even as of next year. I don't know how the events of 2020 and the impact it's going to have on a company like AstraZeneca. They may have a great year, bear in mind the sector they're in, but this has been a long sustained fall long before 2020 came along. Right, this has been dropping since 2010 onwards. We've been the retained earnings of this company have been in free fall essentially, and the return on shareholder equity is very poor, because this is a company that have 14.5 billion in equity, yet they can't make a profit. They're not running at a profit. They've got 14.5 billion in equity. That's assets minus the liabilities equals what's left. You would expect a company holding 14.5 billion on the books in assets, and yet they're unable to generate enough profit. And that's a concern for me in terms of a company that I'm looking to invest in. The shareholder equity has just been very poor since 2013 onwards. And so that's pretty much it in terms of the income statement and the balance sheet. And so we're going to take a look at the charts now, and this is going to kind of flip your mind a little bit, I think. Okay, so we're looking at the chart on a monthly chart. So every single one of these candlesticks represents a month's worth of movement, and as you can see, there's been an obvious trend. This has been a fantastic company to have in your portfolio. So despite those numbers, things have actually been going very, very well. In fact, you could say the real turning point for AstraZeneca was sort of 2016, 2017, when things really, probably 2017, when things started to really take off. Now, this is the year where we started to see some serious decline in the numbers. So why has the share price grown so significantly when the numbers are going down? Now, there haven't been any obvious jumps in goodwill on the balance sheet, so I would imagine there's been no major takeovers going on here. So listen, I'm going to call out to the community here, you guys watching. with every company we look at, there's always a small pocket of people that have really done their research on these companies. Now, I only go deep into these companies when they tick all my boxes, when they look great. I've only got a certain amount of time on my hands. I do not have the time to look at the thousands of companies that are available and go deep into them. Looking at the Astrazeneca numbers, I'm not interested as an investor, but you cannot argue with the fact that the share price has done fantastically over the last, let's say, 4 or 5 years. So I'm interested to know why that is. And if you are one of those few people that have done a lot of research into this company, maybe you can shed some light on that for me and the rest of the viewers in the comments below. So I would urge anybody watching this who does have some insight that I've not been able to share through the numbers as to why we've seen such a jump. Really, I mean, if we look at this, really we're looking at, I'd say argue 2018 onwards, isn't it? From here, when they broke above this price in July 2018, and we've pretty much been carried on going up since then. So what's been happening with AstraZeneca over that period of time? I'd love to know. If you know, please share. But there's no denying here that if you had this company in your portfolio, you would have been doing very well, despite those numbers not being as strong as I would have liked. We will talk about pricing at the £85.50 price right now in a moment. In fact, let's do that now, and let's go and take a look at the leaderboard. Okay, so let's take a look at the share price then of AZN. £85.48 for one share. So pretty damn expensive. Is that good value? For me, no way. Looking at the earnings per share, $1.03 per share, because it's done in American for some crazy reason. If you translate that into pounds, you're looking at less than £1 a share. That works out about 1.2% return on £85 investment. So if you were to buy all the outstanding shares in this company at £85 a share each, and the earnings you're making on a yearly basis is just £1 or less than £1 per share, you get a 1.2% return. That's not great return. That's indicating that the £85 share price is far too high for what you're actually getting in the company. You can also take a look at the equity per share or the net assets per share. You can look at the price to book. All of these pointing towards the fact that £85 is far too high. Equity of 14.6 billion, 1.3 billion shares. So yeah, you're looking at an equity per share value or net assets per share value of £11 a share. Price to book is going to be about 7. So far, the price is too high, basically, for what you're getting. I wouldn't be buying at £85 a share. I think that the shares therefore are overvalued. A good price then for AstraZeneca, I would say, for me to be interested, would be 50-60 quid. Now, it's a long way down to get to that sort of price, which means that if they were the sort of company I was looking for, they would just be one of those great businesses that, for me, I'd have to wait for another massive market correction for me to be interested in buying any shares in AstraZeneca. And those events do come along, for the next 20 years, I'm sure that event will come along and every year this changes, right? So the earnings per share changes, the assets and the equity in the business changes every year, as does the share price. So it's a constantly evolving sort of balance. So we may find AstraZeneca shares don't really increase much over the next 10 years, but the value of the business does, and therefore they start to become a bit more competitive in terms of price, and maybe we'll get to a good price one day. But right now, as a snapshot right now, they're far too expensive for me. 2.5% dividend yield, so they're not a huge dividend stock either. For me, AstraZeneca, too expensive. Also, not a company I would invest in, I'm afraid. Let's chuck them up on the leaderboard. In fact, I'm going to go through the motions, but AstraZeneca are not going to make it onto the leaderboard because they score a rather miserable minus 103 points. So the calibre of the board now is far too high. These sorts of companies do not make it on. Listen, there are going to be people watching this, major AstraZeneca supporters, who are going to be chasing me down the street with pitchforks, I suspect, trying to burn me at the stake for suggesting that AstraZeneca are not a good investment. What this means is that they're not a good long-term investment for me. They do not have the odds I'm looking for and the certainty I'm looking for in their numbers to suggest that over the next 10 or 20 years, this is a company that's going to grow 300, 400% in share price value. I think the shares are overpriced right now, which therefore adds even more weight against the chance that they're going to be up 400% over the next 10, 20 years. I could be wrong, of course, as no one knows what's going to happen. I'm only looking at the odds, I'm only looking at the data and the facts. But for me, this is a company that I'm not interested in because they don't tick the boxes for me of what I'm looking for long term. And if you hate me for it, you hate me for it. There's nothing I can do about that. So thank you so much for watching. I hope you have enjoyed it. I hope you've gained some insight into this business, and I hope you're enjoying the show. We are going to be doing a third show a week from September. If any of you guys saw it, and many people did, many people commented, thank you so much if you did. I put a post out that said I'm looking to do a third show in September. What do we want to cover? And I suggested Belgian shares, maybe French, maybe German shares, but the overwhelming majority of people requested that we do a dedicated show on the FTSE AIM market. Now, there are 750 companies in the FTSE AIM market, and it made me realize that's obviously where the interest is. We're going to get a brand new board, and we're going to do a dedicated AIM show. I do not know which day of the week that's going to be yet, but we're going to be doing it. Awesome stuff. Looking forward to that. Thank you so much for your support. Like I said, if you know more about this company than I have explained in this video and you know facts, please leave them in the comments below. I very much welcome that additional information from anybody watching. Thank you so much for watching, and I'll see you guys on Thursday. Cheers.